This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. Eagle Point Credit Management currently has $12 billion in assets under management. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had $77 billion of assets under management. Our next guest didn't expect to cycle through 6 bosses in 5 years when she joined the financial industry. Hear from her what this taught her about building loyalty, volatility in careers, and sitting next to the power. I'm Aoife Devitt, and welcome to the 50 Faces podcast, which showcases inspiring professionals in the world of investment and beyond by focusing on its people and their stories. I'm joined today by Sonali Pier, who is a managing director at PIMCO in Newport Beach, with a particular focus on multi-sector credit. She previously worked as a credit trader and was named recently to the Marketwatch 50 Most Influential People in Markets. Welcome, Sonali. Thanks for joining me today.
Thanks for having me.
Well, I'd love to start with just a little bit on your background. Can you talk us through your career journey and what led you ultimately to a career in finance and investing?
Sure. Well, I'll take you all the way back to 6th grade. I remember leading our team in the stock market game over that semester. We were excited about our prospects. And, I came to be passionate about markets and eager to open the Wall Street Journal. Back then, you had to open the paper to see where prices were and to be able to track the portfolio's impact. Yet at the end of each team was asked to come in dressed according to their investment returns. Our team, unfortunately, was quite shabby. But that said, we did learn a lot from the experience, and it really sparked my interest in finance and relative value. I grew up in New Jersey, and I went to Princeton, where I majored in economics and minored in political economy and finance. During college, I spent a couple summers at Goldman Sachs and was really excited about how dynamic financial markets are and how fast-paced the environment was. After 2 summers on different desks, I honed in on wanting to trade credit derivatives. I really liked the accountability, how the news flow and consumer trends were impacting companies. That really made it tangible. And I was inspired by the innovation evolving in credit markets specifically. So then full-time, I started my career as a credit trader at JP Morgan in 2003, which was a great training ground for trading, understanding different client types, what investors want, launching new products, and making P&L, profits and losses. JP Morgan was ahead of the curve back then in new product innovation in credit specifically. They created the HYDE, which was the high yield derivative index, a precursor to the CDX index we still use today. I also was able to be the first trader to provide liquidity in new markets, such as recovery locks and annuity swaps, although the latter became defunct with the standard North American corporate contract, the SNAC, having a fixed strike. So I took on these new opportunities really as a way to engage with clients, to provide insights about the products, and as a result, was able to build relationships that led to market share and bond trading too. I love the accountability of having a P&L number to your name and the constructive feedback that the market gives you constantly, like it or not. Then in 2007, I remember getting a little antsy. The spreads were tight. Every day started to feel pretty similar. And then, of course, the great financial crisis happened. And the volatility was an adrenaline rush and or humbling, depending upon the given day.
Really interesting. 6th grade. I don't think we go back that early often when it comes to market choices.
I bet.
also, or market, it was stock recommendations, but definitely a good age to be humbled, I suppose, and to start learning about things going wrong. In terms of your specialty in political economy and finance, how much of that was kind of practical, or was a lot of it kind of on the more theoretical at that stage?
I was always quite interested in how the political economy aspects would affect markets, and they clearly do. I mean, today, Here we talk about the Trump administration and their policies and the sweep being able to enact a lot of those policies and the market impact as a result, whether it's M&A, whether it's a result of tariffs, et cetera. And so, it certainly has an impact on markets, but I also love reading the news. So that all kind of helped bring it all together in terms of why I studied what I did.
And you said you had an early affinity for credit derivatives. That's a fairly complex area to most lay people, I'd say. How would you describe the learning curve there?
Yeah, to your point, I do remember that second summer when I went back to Goldman Sachs, there was, I think, just one person trading derivatives, and there was no high yield credit derivatives. By the time I switched banks and went over to JP Morgan full time, they had 4 investment grade credit derivative traders. And by then they had also merged their high yield desk. So the cash and the derivatives were traded together. So it was absolutely a time where there was a lot of change and growth happening. And so, really, I guess what was interesting to me was that it was a new product. So I felt that, I would have a better chance of, call it, having an edge. And alongside, I would learn about cash bond trading as well.
And forwarding now to why you joined PIMCO and the attractiveness, I suppose, of the growing credit segment there in a firm that is known, I suppose, was originally known as more of a credit specialist. Can you talk us through that?
Yeah. So basically, after trading credit for nearly a decade, I wanted to transition from the sell side to the buy side because the regulatory environment really changed post-Great Financial Crisis. The sell side trader role went from basically seeking a blend of proprietary risk and liquidity market share to becoming more of an agent role where you're matching buyers and sellers. I was attracted to the firm's top-down macro thought leadership and yet how we position like a hedge fund. Deep into credit and looking to nimbly take advantage of relative value where no stone is left unturned in a search for returns, really on behalf of our clients. So today I'm a portfolio manager in global multi-sector credit, and I help lead a number of our credit strategies at PIMCO, including diversified income and leveraged finance strategies, trying to extract alpha from structural inefficiencies and tactical opportunities when the market presents. While having a strong track record that helps you get into that finals, what's rewarding is also building a custom tailored solution for various clients' needs.
It's really interesting. I'd love if you could, given you're in the weeds here in credit every day, talk a little bit about the landscape today, because from an outsider, I suppose, looking in, what I would see is a fairly volatile fixed income complex compared at least to equities and, quite divergent interest rate, I suppose, positioning at this point as one central bank pauses and other central banks continue to cut. What would you say is the opportunity set like today, and how are those factors feeding in?
Yeah, I think the most exciting part is the yield today. We had a significant reset in interest rates, making fixed income a lot more attractive again. As you mentioned, at one point in 2021, there was 17 trillion of negative yielding debt globally. Now the environment for yield generation is one of the best we've seen in decades. Bonds are essentially back because we've had some investors that have been renting the yield in cash markets and are now ready to term it out and get some duration given there's potentially more Fed cuts. And we've had other clients that have had a really good run in equities and now are looking to de-risk a bit and come into fixed income because they can generate at this point in the cycle a very attractive level of yield and therefore income. In particular, we're excited about the broad toolkit in multi-sector credit. The breadth and the depth of the resources across the platform really help us source these opportunities. We often get asked about our size, for example, in credit, being larger is net better. And that's really because there's a lot of information to synthesize for effective portfolio construction. So we'll work with PMs across our research, analytics, risk, trading, and sourcing teams to build a robust portfolio. Today also, we have situations where deal documentation can be quite loose. And so being larger allows us to help advocate on behalf of our clients and bondholder groups directly with the company, or even showing a reverse inquiry to a corporate or a bank really trying to create the bonds we want to buy from them.
How would you say that investor needs and expectations are changing around the asset classes, particularly with respect to multi-sector credit?
The pace of change and growth have been different by credit asset class. This is one of the things that makes multi-sector credit always interesting. At PIMCO, we've been in this space for over 20 years, And today there's a lot more competitors than before. However, not many are as well resourced in each of these interrelated asset classes and integrated to look through all the various risk factors in detail. Our firm's investment committee meets 2 hours a day. We debate and discuss the economy, news, asset classes, portfolio construction, and then we'll even bring in experts from outside, whether it's our global advisory board, as needed along the way. In terms of changes in these asset classes, 10 years ago, high yield was over $1 trillion asset class, but both private credit and bank loans, they were much smaller asset classes, while today they all stand above $1.5 trillion. And investors often want PIMCO to help them with the asset allocation because, the pendulum can swing on fundamentals, technicals, valuations relatively quickly. And, in terms of investors and their needs are changing, but so are the issuers. So, when we're looking for flexibility, and we'll actually provide many of the issuers the opportunity to show, we'll show dual track financing options where we can be agnostic of which asset class they issue in between high yield, bank loans, and private credit. But importantly, we want to make sure we're getting paid for the liquidity and options. So different terms and pricing depending on the asset class they choose to go in. And we've seen a lot of conversions from, say, a company that was in the broadly syndicated loan market going to the private credit market or vice versa.
It's really interesting. And I suppose then, how have credit products evolved to meet those needs? I think you mentioned earlier customization, and that's a new trend of partnering with clients, really trying to tailor things to their needs. What trends are you seeing in terms of what PIMCO is doing or what's being done to meet client needs?
Yeah, so I would say at PIMCO, we've always tried to create customized solutions for each client's needs, especially, through a separately managed account. But today, we're seeing a lot of growth in the ETF market. PIMCO was an early adopter to fixed income active ETFs, and we see a lot of growth potential in this space. And so we continue to innovate here. Some of the investors really want this vehicle type due to its tax efficiency. And so one of those innovations that we launched back in June of 2023, it's a benchmark agnostic multi-sector ETF. And we have broad latitude across credit, but we also have a pretty big toolkit for interest rate exposure as well, where the duration band is 2 to 8 years, so pretty broad. Reception's been very strong. And I'd say there's been a pretty consistent inflows where, this really lets us put money to work on a daily basis, looking for those interesting opportunities. And given it's an ETF, we are laser focused on the transparency and liquidity. And as a result, we stand ready to respond to clients' changing needs as a steward of their capital. This offering also lets us bring PIMCO resources to one offering, marrying the top-down approach with the bottoms-up.
It's interesting. And I always like to ask in these podcasts, like whether we're missing something. I keep mentioning the lay people looking into an area that can be somewhat complex. Do you think that clients or commentators are overlooking any opportunity set right now when it comes to fixed income?
Yeah, I would say we believe that the clients, some are overlooking the benefits of just high quality fixed income, right? Coming off that period that we were talking about earlier, in 2021, where we had 17 trillion of negative yielding assets. Today, high quality fixed income can actually be very beneficial, especially if we were to see, say, a risk off move. Historically, there's been a large give up between return expectations in more economically sensitive parts of the market, like equities or high yield versus high quality fixed income.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him what opportunities he saw today that excited him.
One of the things that we're most excited about, and a lot of what we do at Eagle Point involves investing in CLO equity, the opportunity to unlock value in CLO equity or create value through being a majority investor today is tremendous. And some of the rights we have as a majority investor, and these are protective rights that an investor might have, but the opportunity to either call a CLO or, more interestingly, reset a CLO. And what resetting a CLO means is you keep your same assets. You might have 150 or 200 assets. You're very happy with those loans. Pay off the old CLO debt, pay them back at par plus accrued interest, and then issue new CLO debt at much tighter spreads.
And now back to the show. Do you think we're properly thinking about default risk? Do you think there's any sense of overconfidence around the lack of bankruptcies, the lack of distress in this area?
Yeah, so it's interesting because the default rate has been very low, but I would also say there's good reason for why. And so I don't think that the default rate is going to pick up meaningfully. And it's really because companies were quite disciplined post the peak COVID period and termed out their maturities. And, looking at just the issuance last year, where we had significant portion of issuance across, say, many of these markets towards refinancing, there's not a maturity wall looming. So that's one thing. The other thing is, we were talking earlier about loose documentation. That's really allowed the loose covenants companies to sell assets, raise peri debt, raise even super priority debt, kind of a lot of different options before they really have to go that bankruptcy route. And then because of the loose documentation, there's also this, we're seeing many times companies, when they really do get to that point where they have to decide offering a distressed exchange and really trying to avoid the full bankruptcy and still reduce their debt load. So I would say, we're likely to, even though we're in a period where interest rates are relatively high, companies have been proactive to push out those maturities. And given some of the other dynamics we just talked about, I would not expect the default rate to pick up meaningfully here.
Well, that's certainly reassuring to hear. As we've been looking in, coming from the inside. And my next question is a little bit about our own evolution, I suppose, as a podcast series. We started this podcast in 2020 to showcase diverse role models in finance with a view to just humanizing the profession. And this is a profession you've been involved in from a very early age, I think probably just double digits. I'd love to know what you think in terms of the diversity of the profession today and whether anything has changed over the course of your career.
Yeah, certainly we're making progress. I would say, at least let's start with the investment thought process. At PIMCO, not only do we believe that diverse investment teams make better decisions because they're able to weigh more potential, say, scenarios in their analysis, but we've also weaved in a lot of these behavioral finance principles. Some examples would be, we give our speakers 10 minutes to deliver their presentation uninterrupted before going into the Q&A, make sure that we have an odd number of voting members when voting, ensuring that the meeting lead speaks last, or rather votes last when surveying. So they don't influence others. We have open mic days in our investment committee. We read our best ideas from our investment professionals on an anonymous basis, really to ensure that we're not being influenced by the name on the piece of paper or their seniority. Other things we do is in our quarterly forum process, after a presentation, we'll often ask if there's any dissenters to speak up to avoid that groupthink or assuming that everyone's on the same page. So I would say PIMCO is generally a flat organization with all the portfolio managers actually on the trade floor, not in offices. And I think that emphasizes the ability to engage with senior leadership, and that we really do welcome individuals to contribute productively to the strong investment process. I think one of the key aspects to getting that diversity of thought in the door, though, is early exposure to our industry and then having a strong process, because that kind of naturally will help with recruitment and retention. So while there's still room for improvement, it's certainly improved, at least from the early days I've been involved.
That's really interesting. I love the way you've given some examples there as to how to encourage that speaking up and that diversity of thought. And I would imagine it's a question of practice as well. It's not that
Absolutely.
everybody gets that and sort of feels confident. And I suppose it's also the onus is on management to reinforce as well those practices.
That's right.
It's really interesting. I'd love to just turn to some reflections now. So again, another part of the origins of the podcast is to speak about how careers progress and normalize the very different ways that can happen. Some of us have mentors, some of us don't. Was there anyone in your career progression that was a particular mentor or figure for you that had a particular influence?
Several. So I guess maybe I'll start with, we have a great team here at PIMCO. We discuss our investment principles, trade opportunities, incentives, really to make sure our framework is robust, repeatable, and rewarding. Dan Iveson, our group CIO, he's really brought in and embraced a lot of those behavioral finance aspects to our process that we were just talking about. And, he's also shared very important investment lessons along the way. And those really guide how I construct portfolios with the team. For example, looking for instruments that bend but don't break, really providing those strong returns, but with resilience in the downturn. And then, while I've had a lot of mentors throughout my career, a significant part of what drives me is probably my motivation to overcome challenges. And that probably comes from my family. I'm a daughter of Indian immigrants. My parents sacrificed a lot for this new beginning. My dad came to the United States in 1971 with literally $8 in his pocket and a determination to succeed. My mom subsequently came to the United States after getting married, having only known my dad for 11 days. So I'm the youngest of three, and actually pretty grateful for the teasing that my older siblings inevitably provided, learning from their experiences. With them, I got used to advocating for myself, blunt feedback, rolling with the punches, and, shooting some back. Telling me, I couldn't do something nearly created a drive to prove it wrong. So I'm also grateful for my spouse. He's been very supportive of my career. He moved to Newport Beach, sight unseen. And even my sons, they've been very understanding when something they're looking forward to gets interrupted with work, because they kind of realize that I'm passionate about markets and client solutions. And so I hope one day, maybe one of them will be sitting here, my sons, and they'll be sharing how they are in a career that they love and are persistent in their pursuit.
I love that. Well, certainly, that's the whole point again, is to showcase these role models. And I will say Newport Beach, sight unseen. Probably there are worse places you can move to sight unseen, but
100% agree.
Amazing commitment there. Last question is around pieces of advice. I've got two questions here, just whether there's any creed or motto that you live by.
I guess maybe I'll share one that was more humbling or surprising, I'll say. Earlier in my career, I had a boss who said, in the market, perception is reality. It really reminded me to stay humble in investing, focus on fundamental value, and that can require patience through volatility or a willingness to adapt to news, because the change is constant. It also means that you have to take a longer-term view sometimes, but you have to marry this with your client's objectives. So, for example, while each year is measured in alpha, we look at people's 3-year track records, making sure we're seeing balanced risk-taking. It also keeps us sharp on thinking about what may be affecting markets, say, on a cyclical and secular horizon, meaning areas for short-term performance, but also picking your head up and thinking about what will steer the markets over a long-term horizon, such as the AI, geopolitical risks, Trump administration priorities, central bank policy paths that can differ. And there's a lot to consider when you have a longer time horizon.
It's really interesting. It echoes a lot of what Tiffany Wilding, also of PIMCO, said on this podcast earlier around just that getting used to market volatility and what that does in terms of your comfort level with uncertainty. So thank you for sharing that. And finally, is there any advice you would have for your younger self, whether that young 6th grade stock picker or someone a little bit older? Anything you know now you wish you had known then?
Yeah, I would just say embrace change. Yeah, I highlighted it earlier, but there have been moves in my career that came up unexpectedly, whether it was market related or personnel related. And despite what you plan for it, there will be a lot of change in this industry, whether it's in an asset class, a market structure, liquidity sources, regulation. So embracing change should excite you in this industry. In fact, I remember in my first 5 years in my career, I had 6 different bosses. So, there's a lot that can change. I've learned a lot also from the market volatility and stepping up, say, when there are people changes. So when you take on a new industry, say to trade on the sell side back then, you may not know exactly where the market is or where the bonds are buried. So I always remember this quote from one of my old bosses that he's colloquially say, you have to pay to play. So your first trade might not be profitable, but until you make a market, you don't know. And so you got to take that initiative, be active in your market, and really relish in the opportunity to learn. And there could be friction in those early days, but it's worth the long-term investment. Invest early in yourself.
Wow. Well, there's probably about 10 sets of wisdom in that particular reflection. And thank you for that. And I really do think that was something you said about that bosses really strikes a chord, because that is actually deeply unsettling, having a boss change 6 times, because part of what we're taught, I think, is to build goodwill with our leaders, with our mentors. And that actually takes quite a bit of effort. And to have that changing sometimes without completely unannounced or out of our control is something that is never taught in any university institution. So I think only through hearing stories of others that have gone through the same and lived to tell the tale can we normalize these type of experiences. So thank you so much, Sonali, for sharing so much wisdom here with us.
My pleasure. Thanks for having me.
I'm Aoife Devitt. Thank you for listening to our 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring professionals and their stories, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.